Well, welcome back. It is time for the Word on Wall Street. Top investors watching your money. Joining me right now is Verdence Capital Advisors CEO Leo Kelly and Rebecca Walser with us, and Cheryl Casoni as well. Great to see everybody. Thanks for joining the conversation this morning. I want to get your take on this market, on this, the first trading day of the new month. Dow Industrials up 42. The NASDAQ is down 38, and the S&P down about 3. We've had a great November. Look at these numbers for the month of November, the best month of the year so far. Certainly the S&P saw its second best November since 1980. You're talking about gains across the board for the major indices. JP Morgan CEO Jamie Dimon, however, is not so optimistic about the economy. Yesterday, he said, quote, "A lot of things out there are dangerous and inflationary. Be prepared. Interest rates may go up, and that might lead to a recession." Now, he's been saying this for a while. We still have not seen it. Federal Reserve Chairman Jay Powell is set to speak in a fireside chat about the economy later this morning. Rebecca, the Wall Street Journal's Nick Timiraos writing this morning, the Fed's interest rate hikes are probably over, but officials are reluctant to say so. Do you agree with that?
Well, yeah, Maria, and in that article, they talk about Fed President of New York, John Williams, who was at a conference yesterday and said, like, this is the most restrictive monetary policy in 25 years, but based on the data, it may need to stay so and stay tight for a while. So again, the market is starting to price in a March cut, and we might not get that. It might be many things. It's not necessarily, obviously, we're going to get CPI in another week or so, but and we're going to have the pause right around. I expect a pause. I'm not expecting that there will be another raise. But Maria, the market does not need to get ahead of itself and starting to expect and price in and bake in a cut in March. That is, I think, a mistake because we still have a lot of global macroeconomic and problems here in America that have not been resolved and are not going to get resolved anytime in the near future. So this is a problem that the market's starting to say, oh, you know, a cut in March is coming, and maybe it's not going to come. So that we need to make sure we understand that this is going to potentially be higher for longer.
Yeah, it's interesting to look at the U.S. versus Europe in terms of these expected rate cuts. Now, Christine Lagarde at the European Central Bank has been talking about guidance of second half of the year in 2024 as a potential for cutting rates. But look at where the market is, Leo. They're expecting a rate cut in Europe in April. So there's a debate on who cuts rates first, Europe or the United States. And we look at oil prices this morning to get a sense of the demand situation out there. Prices might be trading more on this OPEC news, though. OPEC announced another output cut of 1 million barrels a day, Leo. When you look at crude at 76.09 right now, down from the highs, is that an indicator for you of growth slowing? Or is that an indicator for you of just OPEC moves? And what does that mean for the U.S. and Europe?
I think it's more OPEC moves. Growth is moderating, especially with the consumer who continues to feel the squeeze of inflation. It's interesting. I know there's a lot of optimism in the market about inflation being down to 3%, but that's 3% higher than 9% last year and the big inflation the year before. Right. So I think with higher interest rates, with higher cost of living, the consumer is stressed, Maria. And while this has been a great year, what we're saying to clients is take a pause, take a breath. We are neutral weighted, and we're neutral weight because there's still too much money in the system. We think inflation is not over. And as soon as the Fed starts to back off, we think inflation roars back. This is going to be a process, not an event. So we think that if you really look, I know people are getting optimistic, and what I fear is a lot of people are starting to root an outcome on. The Fed's going to cut. Why? Because we really want it. Unfortunately, there's still too much inflation. If you look at the 10-year, it's ratcheting higher, higher highs, higher lows. So we think this is the beginning of a secular move in the market. I would also caution one other thing, Maria. It looks great right now. The S&P 500 is up 20%. What a great November. Take a pause and look at the S&P 500 equal weight. Yeah. It's only up 5%. Same Good stocks.
Yeah,
this market from January of 22 is still in a bear. So I think it's a stock picker's market, and you have to be cautious right now and not get overly optimistic at this move.
Leo, does the Fed cut first or the ECB cut first?
I think the ECB. I think the Fed will pause. I am amazed at all this optimism about a Fed cut, especially when the Fed continues to clearly state inflation is a problem. And Maria, again, I've said it before on the show, you know this. We raised the M2 of this country, money supply, by 40% over 2 years. And we've only pulled it back 4. The main problem of government spending and massive monetary supply is still in the system. So while the Fed is slowing the economy down, they can't cut, otherwise inflation will come back. I think people are overly optimistic because for the last 20 years, the Fed put was always in place. Hey, when things get soft, the Fed will save the day and lower rates. I think people have to get used to the new norm, and that is inflation is going to prevent that.
It was Jay Hatfield who was on the show yesterday. He was on The Word on Wall Street yesterday, who said the economic situation in Europe is deteriorating, and we're likely going to see the ECB cut rates sooner than the Federal Reserve. Jay Hatfield here on Word on Wall Street. So we're watching that story. Meanwhile, we could see a good move for Uber today, Cheryl. It could be added to the S&P 500. The ride-sharing app has the largest market value outside the S&P of $116 billion. The stock this morning looks like this. It is up 127% year to date. I mentioned it earlier in the week because there was speculation it goes into the S&P 500. Could happen today.
Verdence is reporting that it's going to be today after the bell. And this is part of their quarterly rebalancing of the index. I mean, that stock is more than doubled this year. It would be a 0.3% weighting of the S&P. So this is a good boost for Uber. And if you look at other recent additions when they've rebalanced the S&P, those stocks have all done really well. Whether it was Lululemon, Airbnb, Blackstone, those stocks actually did very well when they came into the fray here. Uber, by the way, the stock has jumped just 15% since November 7th when they came out with earnings and when they reported to the street.
Wow.
Look, Uber Eats is doing really well. They've done a really good job with cost management. They've had a lot of back and forth, the fighting with the drivers about benefits and fees and things like that. But Uber has really taken a strong tack when it comes to the drivers, making sure they're not employees. That's a win in Wall Street's perception of an Uber, not necessarily if you're driving for Uber right now. The other thing too, though, I think the stock may not move a lot today, only because it seems like this has been baked in already. This has been expected because to your point, that $116 billion market cap for the stock. But again, we're expecting this after the bell, and then they'll start actually trading the morning of December 18th before the bell. That's when we're going to see Uber a piece of the S&P. It looks like it's happening.
And we should point out that when a stock is added to the S&P 500 index, that means that those money managers who mimic the S&P 500 index will have to buy that stock as well. And that's why when a stock is added to the index like that, it goes up immediately. We'll be watching it. Leo Kelly, thanks for joining the conversation. Good to see you. Cheryl and Rebecca, you are with us all morning long. We are grateful. Stay with us, everybody.